What a wild market, ladies and gentlemen. The stock market sold off in a big way, really gapped down in pre-market, and then we sold off even more to hit a low at 372.56. And ever since that low, we have pretty much been straight up. We are almost positive on the day. I imagine we'll close out the day with a pretty decent gain considering the momentum that we are currently seeing. We need to talk about what is going on right now because we got PCE data that came out that was not so good. We had retail spending and retail saving data that was also not so good. So why are the markets rallying? That is something that I think is very interesting that we do need to address here in this video. So we got a lot to talk about, much more than that. Hit the like button and subscribe to the channel if you guys find value out of the video. Thank you guys for tuning in, and let's get straight into it. So first and foremost, the Fed's preferred inflation measure rose 4.7% in May, around multi-decade highs. The key points: core personal consumption expenditures prices, excluding food and energy, rose 4.7% from a year ago, slightly less than expected. Headline inflation remains strong, rising 0.6% on the month and holding near the highest level since 1982. Disposable income and inflation-adjusted spending both declined on the month. Weekly jobless claims totaled 231,000, a slight decline from the previous period. Now, the markets are not caring about the personal consumption expenditure price index. Markets are actually concerned about a recession, and you can see disposable income and inflation adjusted spending both declined on the month. So spending is declining, disposable income is declining. And what can you see happening in the bond markets? Well, the yields are down about 0.10%. If the markets are concerned about inflation, remember this: bond yields will go up. If the markets are concerned about a recession, bond yields will go down. And what happens when bond yields go down? It makes the cost of a mortgage, your interest rate on that mortgage, less expensive, because bonds are competing asset classes with things like mortgages, credit lines, auto loans, basically the cost of capital in general. So if investors are buying bonds today, driving down the bond yield, then they are concerned about a recession, because what happens during a recession? Well, you see massive deflation. You see really uncertain growth, but really you see massive deflation. You see the price of oil coming down in a big way. You see companies dropping prices. So if we go into recession, a 3% yield is not all too bad, and that is what is currently driving the markets today. So there's this tug of war going on between, are we concerned about inflation? Is the growth side of things okay? Or are we concerned about a recession and inflation? Will that just come down with a recession? So there is a push and pull, but just keep in mind, 10-year treasuries, if they go up, you're concerned about inflation. If they go down, you are concerned about a recession. And a recession, even though it's not a good thing, it's definitely a bad thing. It does make the cost of capital, not as expensive. It typically drives down interest rates, and that can be seen as a bullish thing in the short term for the stock market. And I think that is why you are seeing the stock market pretty much bottoming out and rallying today as the bond yields have been falling. So that is the biggest key, the biggest takeaway to get out of this video. Now, beyond that, you do actually have the ISM manufacturing PMI that comes out tomorrow, and that could be important as well. That's going to be another reading into essentially producer side of inflation, so that can be important. And let's see what we're expecting. We are expecting a 56.1% reading, and this has pretty much been falling for a while now. So we're expecting, another fall comparatively to what we've seen last month, and I'm not convinced it's going to have a huge reaction to the markets. I think really, Thursday today was the biggest potential reaction that we would get with PCE as well as personal income and personal spending. And the fact that we have pretty much clawed back to only being down 0.5% after being down almost 2% on the S&P 500, I think that is a very bullish sign. And I am leaning towards a bullish reaction until we get the next big set of data that comes out and we start to get earnings that come out. And I think the next big data point that will be coming out is going to be core CPI. CPI, again, that will come in the second week of July. You might have some other data points here and there that comes out over the next couple of weeks, but I do expect somewhat of a bullish rally until we get that next big data point. And really, I think I've been very clear about this, I think the markets will bottom out once we are confirmed in a recession. That is going to be around July 28th. We get the advanced estimates for Q2 GDP, and we do have the next Fed meeting. That comes on July 27th. We are expecting a 50 basis point rate hike. And then at the same time as all of that, you have earnings that will start to come out for Apple, Microsoft, Amazon, Google, all of those large companies that do dictate the markets. And the biggest concern really with earnings that a lot of people have right now are analysts have not downgraded their estimates for earnings. So analysts still expect record profits, record margins, and record growth for company earnings. If we don't get that, it's not going to be good. We're setting the bar very, very high. Now, on another note, another one bites the dust. Yes, FTX closes in on a deal to buy embattled crypto lender BlockFi for $25 million in a fire sale. Crypto exchange FTX is close to finalizing a term sheet to buy BlockFi, and a deal is expected to be signed by the end of this week. 3 sources familiar with the situation told CNBC. It comes after FTX provided a $250 million emergency line of credit to BlockFi. The price tag is 99% below BlockFi's last valuation, leaving equity investors in BlockFi wiped out and writing off the value of their losses. And this is really bad because it kind of shows you that there's a big problem in crypto. We don't know to what degree this problem essentially is, but you have seen BlockFi going under. You have seen CoinFlex essentially going under. Three Arrows Capital going under. You have also seen Celsius essentially going under. So it's really bad out there, guys. It's really bad in crypto markets, and it is going to weigh heavily on the stock market, especially once you do get a bigger bankruptcy. I will tell you right now, if something like Coinbase were to go bankrupt, it's going to be a big deal for equity markets. I don't necessarily think that is going to happen, but this is something that is dragging on equity markets, and it's something where a lot of liquidity is being drained out of. Obviously, somebody's probably making money shorting the hell out of crypto, but it's one of those situations where it's not a good thing. And we don't know to what extent this is actually happening in the crypto markets. We don't know if FTX is the only brokerage in a good place. We don't know if all hedge funds involved in crypto are not doing good, or if it's just a couple large players like Three Arrows Capital. So that is something to keep in mind. You're also seeing that natural gas drops 10%, on track for the worst month in more than 3 years. At the same time, the market's worst half in 50 years has essentially happened today. So this is the worst start to a year, the worst half of a year since 1970. Considering inflation is the highest it's been since the 80s, it makes sense, but I think that's wild to actually put into perspective. You are seeing some killer deals in equity markets that you have not seen in a very long time as well. So I'm under the assumption the stock market will come back, that you want to be a net buyer of all of these assets, especially some of, our favorite stocks, your SoFis, your Squares, your PayPals, potentially other great businesses as well that are beaten into the ground. You want to be a buyer of those because eventually, once inflation comes down, once the Fed can actually U-turn, that's when those stocks are going to explode. And that is when you guys can take, a decent sized position into a massive size position once you do get that appreciation. Now, if we do go ahead and look out to next week and what kind of data we have coming out that can move the markets, you do have factory orders month over month for May. That can be very important, but that is it for Tuesday. For Wednesday, you have JOLTS job openings, ISM non-manufacturing PSI, which does tend to be a little bit more important than, the essentially data we are getting tomorrow, the ISM manufacturing PMI. You do also have the FOMC minutes coming on Wednesday. So I do think Tuesday could be a pretty bullish day, and I do think next week will likely be bullish as well. And the reason I say that is because so much bad news is already priced in. The markets are already expecting a recession. So the more data we get indicating we are going into a recession will push down the bond yields even more. And in the short term, that will be a bullish thing for the markets. Obviously, once we go into a technical recession, July 28th, like I said, the markets realize the Fed is raising rates during a recession and inflation is too high. At the same time, you have quantitative tightening and you just don't know where company earnings are going to go. That's when the markets flush out to the downside. That's when the margin debt really comes back to haunt the markets. You get that flush out, you can find a bottom and then start to trace back to the upside. So there is that is all the way up until Wednesday. For Thursday, you do have ADP employment change, balance of trade for Canada. That says it's expected to be a high volatility catalyst event. Not sure Canadian data will be that important, but on Friday you do have non-farm payrolls for June, and then unemployment rate for June, average hourly earnings participation rate. That's something the Fed likes to pay attention to as well. Non-farm payrolls for private government payrolls, a lot of job data, and that will be very important as well. Wholesale inventories month over month. But I do think, like I said, the sooner we go into recession, potentially, the better the outlook will be for inflation, and the outlook will be for the credit markets. The cost of capital will come down like it always does during a recession. So that is pretty much going to be all for this video. That is what you guys need to know. Nothing too crazy to actually add, just besides it's been a very strong day so far because the fears of a recession. So the markets are firmly starting to price in this recession. Again, I will say it, if the bond yields go up, markets are fearful about inflation. If the bond yields do continue to go down, then the markets are expecting a recession, and that's exactly what it looks like we have been seeing ever since we did peak out and investors started to freak out about inflation. Bond yields hit 3.5%. You have seen really the recession fears take over ever since then. You have dropped about 50 basis points since June 14th in the 10-year treasuries, which is a monstrous move nonetheless. So that is going to be all for this video. Hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. If this does not make sense, make sure to ask the question so we can acknowledge it in that comment section, because this is one of, if not the best buying opportunities that you have ever seen in your lifetime, that you will likely ever see again in your lifetime for a very long amount of time. So get yourself those free stocks with Webull, Moomoo, and Public as well down below in the description. Thank you guys for watching, and I will see you in the next